In recent months, the stock market has shown signs of recovery, attempting to rebound from its previous lows and regain lost ground. However, despite these positive movements, there looms a shadow of uncertainty that could potentially lead to a further 10% decline from its current position. Welcome to Stock Whispers, your gateway to investment brilliance. Today, we're tackling a hot topic: the market's efforts to bounce back from recent setbacks and the looming question on every investor's mind. Why could we see a 10% drop from here despite signs of recovery? In this video, we'll break down the complex factors at play, from economic indicators to global events, and dissect how they're shaping the market's current trajectory. To kick things off, let's first take a detailed look at the S&P 500 index, often referred to as the market's thermometer due to its ability to reflect the overall health of the stock market. Recently, the S&P 500 has experienced significant fluctuations, resembling a roller coaster ride with its ups and downs. Specifically, on February 16, 2024, the market ended the day at 5,005.57. This figure represents a decrease of 24.16 points, or a 0.48% drop from its previous closing value. Such movements are crucial for investors and analysts alike, as they provide immediate insight into market sentiment and potential trends. However, understanding the significance of this decline requires delving deeper than the surface level numbers. The drop of 24.16 points in the S&P 500 is not merely an isolated event. Rather, it's an indicator of the market's current volatility and the various factors influencing investor confidence. This slight dip, while seemingly minor, is part of a broader context that includes economic indicators, global events, and financial forecasts. It's essential for those interested in the stock market to consider these fluctuations within the larger framework of market dynamics, as they can impact investment strategies and decisions. The S&P 500's movement on February 16th is just one piece of the puzzle, hinting at the complex interplay of forces driving the market's behavior. Taking a more detailed look into the market's activities, the fluctuation range for the day reveals a lot about the current state of uncertainty within the stock market. The S&P 500 index swung between a low of 4,999.52 and a high of 5,038.70. This variability within just a single trading day highlights the ongoing debate among investors about the market's direction. Such a range is indicative of the market's current volatility, as investors react to the latest news, economic reports, and global events. These daily movements are crucial for traders and analysts who try to understand the short-term trends and make predictions based on this volatility. However, when we step back to view the broader picture, the market tells a story of resilience and growth over time. Since the beginning of the year, the S&P 500 has seen a commendable increase of 4.94%, showcasing the market's ability to recover and push forward despite the challenges. Even more impressive is the 12-month growth rate of 22.71%, a clear signal of the strong underlying momentum that has fueled the market's recovery from past downturns. This long-term growth is a testament to the market's inherent strength and the confidence investors have in the future of the economy. It underscores the importance of looking beyond day-to-day fluctuations to understand the market's overall trajectory and the potential for continued growth. Diving into the details behind the stock market's performance reveals a tangled web of influences that can push and pull the market in various directions. At the heart of these fluctuations are economic indicators such as inflation rates, unemployment figures, and GDP growth, which provide insight into the health of the economy. Corporate earnings reports also play a critical role as they offer a snapshot of a company's profitability and future prospects, influencing investor decisions and market trends. Additionally, geopolitical tensions, such as trade disputes or political unrest, can create uncertainty in the market, leading to volatility as investors react to the potential impact on global economics. Investor sentiment, the collective mood or outlook of market participants, is another crucial factor that can drive market movements. This sentiment is shaped by the current news cycle, market analysts, and the overall economic outlook. Positive news can lead to a surge in investor confidence, prompting buying sprees, while negative news can trigger sell offs. Understanding these underlying factors is essential for investors trying to navigate the stock market's often choppy waters. By keeping informed about these various elements, investors can make more educated guesses about where the market is headed, enabling them to devise strategies that can weather market volatility with greater confidence and potentially yield better returns. In the recent past, the stock market has shown signs of resilience, making efforts to recover from previous downturns. It's like watching a fighter get back up after being knocked down, determined to regain their footing. This journey back to stability, however, is fraught with challenges and is rarely straightforward. Even though the numbers show positive growth for the year so far and an impressive rally over the last year, there's a sense of unease that hangs in the air. Investors and analysts alike are keenly aware that the market's current stability doesn't mean it's immune to future setbacks. The growth we've witnessed is encouraging, but it's also accompanied by a nagging feeling of uncertainty about what lies ahead. The big question that looms over everyone's heads is what might trigger the market to experience a significant drop, potentially by as much as 10% in the near future. This concern isn't unfounded. The stock market is influenced by an intricate web of factors that can shift investor sentiment and market dynamics almost overnight. From sudden changes in economic policies and interest rates to unexpected geopolitical events or a downturn in major economies, any number of triggers could lead to a substantial decline. The recent history of positive growth does provide some cushion, but it also sets up a scenario where the market could be seen as overvalued, making it ripe for a correction. Investors are thus on edge, closely monitoring news and market signals, trying to anticipate the next big move. In such a volatile environment, the possibility of a 10% drop isn't just speculative. It's a scenario for which many are preparing, highlighting the ever-present need for caution and strategic planning in the world of investing. When we try to understand what might trigger a significant downturn in the stock market, it's crucial to look closely at the various factors that can influence its direction. One of the most unpredictable elements is inflation. Inflation can act like a double-edged sword. On one hand, it signifies growing economic activity, but on the other, it can rapidly decrease the value of money, making goods and services more expensive for consumers and reducing the profit margins for companies. This erosion of purchasing power is a significant concern for both consumers and investors, as it can lead to decreased consumer spending and lower earnings for companies, which in turn can negatively affect stock prices. Additionally, interest rates play a vital role in the economic landscape. Central banks around the world adjust interest rates in an attempt to control inflation and stimulate economic growth. These adjustments can have wide-ranging effects on the stock market, as higher interest rates can lead to higher borrowing costs for individuals and businesses, potentially slowing down economic growth and affecting companies' profitability. Given the current state of the market, which is trying to stabilize after recent fluctuations, it's important to approach investing with a sense of caution. The market is still vulnerable to sudden changes and various factors, such as unexpected geopolitical events, changes in government policies, or worse than expected economic indicators could easily disturb the fragile balance. Any of these events could act as a catalyst for a market correction, where stock prices adjust sharply, possibly by as much as 10%. This potential for a significant correction underscores the importance of being prepared and maintaining a well thought out investment strategy that takes into account the possibility of sudden market movements. Investors should keep a close eye on economic trends and adjust their portfolios accordingly, seeking to balance risk and reward while remaining agile in the face of market volatility. In these unpredictable and often volatile market conditions, investors may find themselves searching for the best strategy to safeguard their investments and possibly even capitalize on the market's fluctuations. One of the most effective strategies in such times is diversification. By spreading investments across various asset classes, such as stocks, bonds, real estate, and even commodities, investors can significantly reduce their risk. This is because when one market segment experiences a downturn, another might be performing well, thereby balancing out the overall impact on the investment portfolio. Moreover, it's crucial to adopt a long-term perspective towards investing. Short-term market dips, while potentially alarming, often offer opportunities to buy quality assets at lower prices. Investors who possess patience and the ability to identify long-term value can use these moments to their advantage, acquiring assets that will contribute positively to their portfolio over time. Staying well informed is another key element in navigating the stock market successfully. Being up to date with the latest market trends, economic news, and financial indicators allows investors to make well informed decisions. Knowledge is power, especially in the world of investing, where understanding the broader economic environment can provide critical insights into potential market movements. At Stock Whispers, our mission is to equip you with this knowledge. We strive to deliver the latest, most accurate market insights and analysis to help you stay one step ahead in your investment journey. By keeping informed through reliable sources and conducting thorough research, investors can better prepare themselves for the ups and downs of the market, making strategic decisions that align with their financial goals and risk tolerance. And that wraps up our deep dive into the stock market's recovery attempts and the looming possibility of a further downturn. Remember, the key to successful investing lies in informed decision making and strategic planning. Thanks for tuning in to Stock Whispers. If you enjoyed this video, give us a thumbs up, subscribe, and hit that notification bell so you never miss out on our expert investing advice. Until next time, keep listening to those whispers and let them guide you to your next big win. See you soon!